Hello Sebastian, and thank you for joining me to talk about your new book, More Money Than God, which I must say I found a fascinating read, and I really want to congratulate you. Because not only have you got great characters, great personalities, really fantastically memorable stories, you're also touching on some very big, important economic themes about where we go in the future with financial regulation. And something I find fascinating is that most ordinary people, if they pick up a book about hedge funds called More Money Than God, Hedge Funds and the Making of a New Elite, they'd assume that you've written a book that's basically bashing hedge funds, because that's been the popular line in recent years. And yet you're...
That if you look at across the financial system and you say, well, there's going to be financial risk, first of all, let's just stipulate currencies will go up and down, interest rates will go up and down, there'll be difficult decisions about where you allocate scarce capital in an incredibly complex economy, and you'll make mistakes, there will be bubbles and crashes and so forth. Which is the least bad kind of financial vehicle in which to entrust investment capital? And I think what history shows is that hedge funds are rather good at this. I mean, during the crisis in 2007, 2008, they came out well. 2007, when everybody else was losing money from subprime mortgage investments, the hedge funds were on average up 10%. Even the hedge funds that were supposed to specialize in asset-backed securities, in other words, that includes subprime mortgages, they were flat for the year. So they totally dodged the bullet at a time when, everybody else was getting...
Some of them still went bust, though. I mean, I remember writing stories myself as a journalist about funds that were going bust.
So Wood Capital went bust in 2007, that's one example, but there were several, as you say. And in fact, one of the nice things about hedge funds, one of the attractions is they do fail, but they are small enough to fail. They're not too big to fail. When they fail, they go down, and in fact, about 5,000 did go bust in the last decade. But they do so without taxpayers taking a hit, without the government getting involved, and also even without creditors in general taking a hit. Because what happens is hedge funds mark all their positions to market, so when they start losing money, you see it instantly. And because of the way they borrow money on a short-term basis from borrowers who can sort of basically yank the loans in immediately, when they go down by about 50% or so, they tend to be wound up before the lenders, the creditors, have to lose any money.
So you're basically saying it's a good thing if the hedge funds do the risky stuff because they can kind of die and we don't really care.
Exactly.
What about long-term capital management? Because there you have an example of a hedge fund that did implode spectacularly and it created a huge, almost systemic crisis.
Well, I think the almost is quite interesting there. I mean, I agree with that. It is almost, but not quite. I mean, in the long-term capital management case, what happened was that the Fed came in and convened the meeting at which the bankers, were made to, were arm-twisted into providing a recapitalization. There was no government money involved, and in fact, Peter Fisher, the Fed official who convened those meetings, explained to me how he was getting ready to stand on the table if the bankers hadn't provided the cash, to tell everyone to put down their cell phones, and there was going to be a public announcement at the same time so nobody could call their own bank to say that the bailout had failed. What that story tells you is that there was no plan B for the Fed. It wasn't as though if the private sector had failed to do a bail-in, the government would have come in with money in the end. And so, long-term capital is a warning sign.
But it did actually shake the system as a whole, because I mean, it's all very well saying, well, these hedge funds are so small, we don't really care about them. If you look at how big some of these funds have become, they're bigger sometimes with their assets under management than your average small bank in some countries. I mean,
yeah, I mean, if you think about Bear Stearns, right, which was when it went down in 2007. Considered to be on the cusp of whether it really needed to be, there's still a debate about that, whether you had to bail out Bear Stearns. And I think Bear Stearns' assets, before it went wrong, were in the order of 300 billion, something like that. If you look for hedge funds which have assets of 300 billion, in other words, capital times leverage, they're incredibly scarce. I mean, I would think that if you take the 9,000 and something hedge funds that there are, you might find a dozen, maybe 2 dozen, that hit that criterion. So, of course, there are exceptions. The really big ones, as you quite rightly say, do warrant public attention. But they are such a small fraction of the total that I think the bigger point that people need to understand is that most of these things should just be encouraged. The government should encourage hedge funds, because the more financial
But that's
risk...
not really what they're doing at the moment. I mean, if
No.
you look to Europe, the Eurozone, I mean, people talk about hedge funds being like locusts, and there really is a sense that hedge funds are the ones who are destabilising the system. And even in America, with the financial reform bill, there is now a requirement that hedge funds are registered and essentially subject to more scrutiny. I mean, do you think that's the right thing to do, or do you think that's missing the boat?
Crazy, crazy. I mean,
Crazy,
the
right.
rule in America is going to be, if you have $100 million in equity, you have to register with the Securities and Exchange Commission. Well, I'm sorry, $100 million is de minimis. It's nothing. It could just, you could...
Well, not to ordinary people it isn't, but
But in terms of the financial system, if the public concern here is that a hedge fund could destabilize finance, at that kind of size, you simply can't. So why is the SEC going to waste its time taking all these registrations? What will it do with that information? Why create a barrier to entry? When I was researching my book, I met a woman who had recently graduated from Yale Law School, and so she knew the law, and for some reason she knew China very well. So she set up a hedge fund that would invest in Chinese bankruptcies, because she could figure out in a bankruptcy which piece of debt in China would pay out at what ratio.
So the kind of smart entrepreneurial American dream, if you like.
Yeah, exactly.
Yeah.
And it's, she went to her friends who had also been at Yale Law School with her, and they weren't rich because they still had some student debt, they were working for public prosecutors, whatever, but they had a few $1,000s that they could have invested. But that is illegal in the United States, because you cannot raise money as a hedge fund from investors who have less than, I think, $5 million in liquid investable assets. And so this is an example where, well-intentioned regulation, which says, let's not have regular people invest in hedge funds. And that might be the right call. But we have to remember that the consequence is it creates a barrier to entry for these small, attractive entrepreneurial boutiques, which ought to be managing the risk.
Right. I mean, the irony is, of course, that in recent years, many of the banks themselves have started to act a bit like hedge funds. I mean, do you think that all the risky activity, all the hedge fund trading should be taken out of the banks? Is that what you prefer? And basically, lots of the colourful characters you write about would be the only ones doing it, and the banks would be boring like utilities?
I do think that there is a problem when you put very risky activities in basically government-insured, government-backstopped institutions, which are backstopped both in the sense that they take deposits which are federally insured. If they have an asset-liability mismatch, they borrow too much short-term, they have insurance in the form of access to the Federal Reserve's lending. Those kinds of safeguard, and just the fact that they might be too big to fail, and therefore, that's a third kind of backstop, that just encourages you to take too much risk. And it encourages your lenders to think they can lend without really scrutinizing how risky you are, as you've written a lot in the Financial Times. So I think that separating out this risky activity and putting it in a vehicle where the investors, the hedge fund managers, have skin in the game. If they lose, it's their own money because they invest their own savings. It's not too big to fail, it's small enough to fail. There's no federal deposit insurance, whatever. I think that's much more healthy. So the Volcker rule, which is trying to separate out the two activities, is good in principle. The question is, in practice, drawing those lines.
Well, that's going to be an issue people are going to be fighting back for a long time, because, of course, there's a lot to be done in terms of actually turning the financial bill into tangible rules. But, I mean, I think a lot of people who pick up your book with its fantastic title, and where did you get that idea from, by the way? I mean, was that your agents, your publishers? Did you like the title?
It came out of a discussion with my brilliant agent, but it was what really sealed it.
It must have really irritated a lot of hedge fund managers, I imagine.
It doesn't go down too well, I'm afraid, with the hedge fund managers, but hey. The truth is that, I think it's a fair title in the sense that when J.P. Morgan died in 1913, there were two facts about it. One was that he was known as Jupiter because of his godlike power over Wall Street. The second was that his entire fortune in today's dollars came to $1.4 billion. That's what he
Only 1.4 billion. I mean, that's a lot of money for ordinary people. But, compared to some of the guys you write about in your book, that's almost peanuts.
There are plenty of guys in my book who make $1.4 billion in 1 year. Right? They make more money than Jupiter or more money than God in 1 year. So I think the title is perfectly fair.
But isn't that part of the problem? Because I would bet that the real reason a lot of people would pick up this book and want to read it is actually not about the serious policy stuff, not the kind of geeky question about how you put risk in the system, they want to read it because it's a fantastic inside story of some of these characters. And these really are amazing characters. I mean, starting even with the original founder of the hedge fund idea. Can you tell me a bit about, how and why this hedge fund concept first sprung up?
Well, Alfred Winslow Jones set up the first hedged fund, as he called it, in 1949. And he was an interesting character. He'd been sent to Berlin as a young State Department official in 1930 when the Nazis were just starting to rise. He'd fallen in love with a beautiful German anti-Nazi activist.
The way one does, yes.
The way one does. And he became impassioned not only about her, but about her cause.
Right.
So he started running these undercover anti-Nazi missions, going to Britain, going to other places to try to raise money for the underground, essentially. And even after his wife divorced him, she was, by the way, a serial marriager of various people for various reasons.
As often happens even today on Wall Street, but yes.
He came back, settled down in New York, married an American woman the second time and said, honey, now that we're married, we should have a honeymoon. I think we should go to the front lines of the Civil War in Spain. So they went there.
So he was a risk taker in every sense.
Exactly.
Yes.
They met Ernest Hemingway. They went to the front lines with Dorothy Parker. That was the kind of person he was. When he set up his hedge fund, it was, he then became a journalist, but he wanted to make some more money. So this was sort of plan B to try to do it through investments. He set up this fund and he did the same thing as before. He was secret, clandestine, under the radar. So he didn't register with any regulator. He didn't advertise to anybody. He just raised money by word of mouth, which often meant a word between mouthfuls at his dinner table. So that's how it all got started.
Wow. So the same kind of subversive, clandestine approach fed into the hedge fund world at the beginning.
Coupled with some intellectual insights, of course.
And, I mean, how would you actually define the hedge fund? I mean, perhaps we should have started that at the beginning, because, the word hedge fund's chucked around very loosely, but what for you are the key elements that have been there all the way through?
Well, I think apart from this element of trying to avoid regulation and therefore maintaining flexibility of investment style, the other things are the incentive fee. A.W. Jones, the founder, said, the Phoenician merchants of ancient time, when they took a successful sea voyage, they would share the profits with their financial backers. The backers got 20%. The backers got 80%, and the captain, the sea captain, took a fifth. Jones said, I'm the sea captain, I'm taking a fifth of the upside here. And that incentive fee has made it, basically spurred hedge fund managers to really push for the inside, the edge, that will make them beat the opposition. So that's the second characteristic.
And that's where the 2022 ideas come from right from the beginning, is it?
Yeah.
Because even today, most hedge funds, at least until very recently, were typically paying their managers 20% of the upside, 20% of the profit.
That's right. And I think that does give you the incentive to get the profits. At the same time, you put your own money in the fund alongside your investors, so that gives you an incentive not to be crazy.
So if it worked for the Phoenician sea captains, it could work for the people in Connecticut today.
Well, the Phoenician sea captain, he really had skin in the game, because if he sank, then that was his skin.
It's not quite like that in Greenwich, Connecticut today, but anyway, although some might feel like it.
And then there's hedging, of course. That's another characteristic, which means you're long and you're short. And the point of that is that by betting on something's going up, something's going down, you're screening out the general risk in the market. So you don't have to have a view on whether the stock market as a whole is going up or down. You don't care. What you have a view on is that this particular company, Ford Motor, is going to do better than the other one, General Motors, because you think the management's better or whatever. So you can isolate specific types of risk that you do have a view on, bet on those, and you can bet bigger by leveraging, by borrowing money, because you've hedged out the kinds of risk that you don't have a view on. So it's being more kind of targeted, more of a rifle shot.
So in a sense, it is the original capitalist entrepreneurial American dream in one of its purest forms, if you like.
I think that's right. And so I think the final characteristic to point to about what defines a hedge fund is this sort of freestanding, boutique-y, hedge fund. I mean, I was struck at the beginning of my research that if 4 entrepreneurial people set up, a kind of quantitative fund on the West Coast, a quantitative company, it's doing software. These are software people. People love that. It's on the cover of various magazines and so forth. People think, but if the same kind of people do it on the East Coast, it's probably finance, it's probably a hedge fund, and people don't like that. So it was a sort of cultural double standard I wanted to...
But one of the problems is that, if you look at somebody like Bill Gates, no one begrudges him his quadrillions of dollars because actually he's made something that has enriched ordinary people's lives. And there is a sense of doing tangible stuff that we can actually touch and feel and celebrate. The problem about hedge funds, though, to most ordinary people, is they are being earned squadrillions of dollars, more money than God. They live in a world where 1.4 billion seems like quite a paltry sum sometimes. And yet they're not doing stuff that actually enriches the lives of ordinary Americans.
Well, let's take an example. So, I mean, somebody who really does make more money than God is James Simons, who set up a very mathematically intensive quantitative fund called Medallion, which has been up, every year since 1990, often up 50, 80% in 1 year. So he's making more than $1 billion every year, all right? And what he does is he basically uses high-order mathematics, which began with code-breaking mathematics, and then also used software translation mathematics to recognize short-term patterns in markets. So he might buy, hold it for a short time, maybe a day or two, sell again. And so this is not only incredibly profitable, but also it's exactly what you're talking about. What does that do for capitalism?
Yeah, I mean, why should anyone care? It sounds
in
like
and out, rapid trading.
Sounds like kind of candy floss finance, sort of cyber finance. It's all kind of Star Trek finance,
Well, I suppose, but the answer is about why it matters is that if you want people to buy stocks, which we do because we want risk capital, people to provide money to risky enterprises, because risk-taking is what drives new jobs, new companies, and so forth. If you want them to buy stocks which have risk, you need to be they need to be able to sell those stocks as well. And when you have lots of participants like James Simons coming in, coming out, they're effectively making it so liquid, there's so much trading in the markets, that people's exit from a position they suddenly don't like is much cheaper. They know that there will be somebody they can sell to because there's so much activity all the time. And so, although it's very abstract, and it's understandable that people don't see why it's beneficial, the truth is that actually rapid trading hedge funds are making it possible for ordinary investors to allocate capital to risky companies and drive the economy forward.
But isn't the problem, though, that, okay, you had these incredibly smart eggheads who, if they weren't off doing hedge funds, would probably be off sort of creating something in Silicon Valley. First of all, maybe they would be better for the economy if they were doing things in Silicon Valley and actually doing tangible engineering stuff, science stuff, the type of activities that America so badly needs to be developed. But secondly, isn't there the danger that they're so much smarter than everyone else, they're constantly going to be preying on the dumb money? I mean, you and I probably have a lot of our money tied up in pensions, in dumb money kind of products, and they will always end up being the losers to the hedge funds.
Well, it's two really good points, right? So, but the first one is, could we better allocate this human capital? And it's true. You go and see James Simons's campus on Long Island, and there are all these incredible, not just PhDs, but people who are established, mid-career academics, and then they become the best statistician in academic mathematics, and then they get hired by Renaissance Technologies, and they no longer publish because everything they do is secret now, and it's about perfecting their black box trading system.
Which means basically all the ordinary researchers who could actually benefit from that research lose out.
Yeah, and then when I was going down the corridors of this campus, first of all, you see these little mirrors on the corners, which are those kind where if you're coming around the corner, you can see what's coming. And that was installed because one of these mathematicians goes around on a unicycle. And you need to be able to see if he's coming in case he might crash into you. Now, in his previous life, this guy was inventing at IBM, the research lab, he was inventing new translation software. And now he's not doing that, he's doing finance. Then this other guy, this mathematician, on his door, I think it was him, one of these people had a sort of a little journal article sort of stuck up, and it said, why most published research is false. In other words, no, I'm not publishing, I'm just doing this research, I'm putting it into the hedge fund's black box, but I'm not sharing it with the general public. Now, is that a misallocation of human capital? Well, I think the answer is, first of all, we don't have a magic wand. Nobody knows precisely how we should allocate the smartest people around the economy. So either we've got to let the market do it, or we're going to override the market with some, presumably, government policy that says we're going to drive people out of finance into something else. How does the government know? I mean, wouldn't the government make more of a mess in allocating human capital than the market? The market isn't perfect. But would the government be better? That's one kind of point.
So if it was really, truly economically valuable for the economy as a whole to be having more bright people going into saying, making widgets in Ohio, then the market system should have evolved that way to reward that. Is that what you're kind of trying to say? Or?
Well, I think I'm making, first of all, a less ambitious claim, which is simply that even if the market's a bit wrong, it might be less wrong than the government would be if the government came and said, we brilliantly know better that we should have allocated some of these mathematicians to software development. What happens if actually software development in the next 20 years turns out to be a stagnant place and you should have put them instead in human sciences?
Or biotech, yes.
Yeah, biotech, exactly. So it's very difficult to allocate smart people, and nobody knows how to do it, and maybe the market is less bad.
Okay, so that's the justification for why they're all sitting there, all those brains sitting there in Connecticut or Greenwich or whatever. What about the problem that actually they're so much smarter than your mum and pop investor, that the average person will always get screwed or always get into trouble if they are basically trading against a hedge fund?
Well, one of the things that people don't always remember is that although it's true that around 1990, nearly all the money in hedge funds was from rich individuals, by now about 2/3 of the money in hedge funds comes from institutions. And that's a transformation. And so it means that university, college endowments have their money in hedge funds, retirement systems put their money in hedge funds, non-profits, like the one I work for, the Council on Foreign Relations, they invest the endowment that's funding the research in hedge funds. So when hedge funds do well, it's actually benefiting not just rich people, it's benefiting some social causes. So if you go to Yale University, they did a study actually in 2005, and they said, our endowment now has $14 billion in it at that time. How much of this is due to the way that we've been investing in hedge funds since 1990? And they figured out that basically they'd outperformed the average college endowment, and the outperformance had generated 7.8 billion out of the 14 billion that they had. So more than half of their money was the result of better investment management. So that the guy who'd done this, David Swenson, the manager of the Yale Endowment, had basically given more to merit scholarships, science facilities than any of the storied education philanthropists one could think of. Harkness, Mellon, forget it. I mean, one guy, David Swenson, who was putting money in hedge funds, had done more for Yale.
Of course, in 2008, that all went horribly wrong, and Yale
yeah, but in
and the other endowments
2009,
lost
that's true. But
money.
in 2009, they came back. So I think Swenson's...
Okay, so that's the social justification that actually, hedge funds don't just uphold the capitalist free market principles, but they also essentially create wealth that can benefit people beyond just the hedge fund managers. But the problem is, though, that to go back to your Phoenician sea captain, you still have 20% of the upside or 20% of the profit going to a very small group of people. And one of the things that makes your book compelling reading is the details of what these guys do with this money. I mean, that is just fascinating. I mean, do you want to tell me a bit about some of your favourite anecdotes of some of the wonderful examples of conspicuous spending or extraordinary lifestyles that most people don't usually get to see?
Well, I think there was a guy called Lewis Bacon, who runs More Capital, and
he was the one who put the sea turtle monitors on or something, was
yeah,
he?
he wanted to. He's a great conservationist, and he wanted to monitor exactly the habits of these turtles. So he put little electronic monitors on them to see where they were going. You have Steve Cohen of SAC Capital, who apparently has at his home not only his own golf course and all that kind of thing, but also he somehow had a planetarium with a ceiling which was painted with a precise constellation of stars that had been there on his wedding night, sort of 15 years earlier.
Well, that's quite sweet. I mean, it's also an extraordinary use of money, but it's also quite sweet.
And then, of course, there's some philanthropy, which we shouldn't forget. I mean, there's George Soros and...
In the current environment, I guess the question still is, if you believe in the American dream, if you believe in rewarding people for taking risks, do you actually need to reward them that much?
No, I don't think you do. I mean, I do think that one of the things that Alfred Jones kind of came up with at the beginning has turned out to be a bit pernicious, which is that he counted the investment profits that he took, that 20%, he counted as a capital gain. So it was taxed at the low capital gains rate, not the higher income tax rate. And that continues to be an argument to this day. Should we change that to make it taxable at the income tax rate?
So they're basically tax dodging, in a sense. Or not tax dodging, but they're basically, once again, gaming the system in a very clever way, because you have these clever brains.
Yes.
For the benefit.
Yes, that's totally right. And I think
probably
we should change
paying,
that.
in some cases, probably paying less tax than your average cleaner, I would imagine.
Yeah, indeed, the cleaners who come and clean their own kitchens are paying a higher tax rate. Or probably, well, it depends on what income tax bracket they are in, maybe not. But certainly it doesn't pass the smell test to have people who, for a living, invest, and then they get paid income for that investing, and they say it's a capital gain. I'm sorry, I don't think it's a capital gain. I mean, when you have not only a fiscal crisis, which we're all going to live with for the next decade plus, right? Which has been massively exacerbated by the financial crisis, and we need revenue from somewhere. But also you've got all these data that show that the hugest inequality that has emerged in the era of globalization is not really between sort of the averagely rich and the rest, it's between the super rich, which have just exponentially taken off. And I think raising taxes on those people is fair and necessary. And in the case of hedge funds, I think it's just obvious that we should tax their income as income.
That can't have won you many friends amongst the hedge fund community for saying that.
No, it doesn't.
Along with the title.
Yeah, I've got the title against me, I've got the tax position against me, but...
But I mean, there again, I mean, must say, presumably if you have 1.4 billion or $14 billion, I mean, the average person would say, well, why complain about losing an extra $2 or $3 billion?
Yeah, and actually,
are you really going to miss it?
Sometimes if you put them in a quiet room, I think hedge fund managers themselves would admit that it's perfectly fair to tax. I mean, I certainly know some who believe this, that they should pay more tax and they should pay this carried interest should be taxed as income. And they don't have an objection to that. And really, at a certain point, money is more than you can spend.
Yeah.
And it's about keeping score. So you want to show that you're clever because you've earned this much. But if you have to pay more tax, it's not as if you're going to move to some tax haven like Bermuda where you can't see your friends anymore. You're going to stay in New York and Greenwich.
I mean, I must say, it strikes me that from a political sense, given that we are living at a time of tremendous public anger, tremendous public pain. I mean, average people are really suffering. Not just in America, but Europe too. And there is invariably growing envy and frustration and finger-pointing. Don't you think it would be a very smart thing for the hedge fund industry to do, to actually come out and voluntarily say that there should actually be some changes in the tax code to show that it was playing its part?
Yeah, I think it would be good. One is asking them to sacrifice the piece of their operation, which means the most to them, i.e. how much they take home. So maybe it's not going to happen. But I think even if they don't come out and say that, it should be done to them. I mean, I think...
And do you think the government would ever have the balls to do that? I mean, in London, we started some kind of debate about that. The European Commission, again, is talking about trying to look at this, but, I mean, there hasn't really been very much actually done yet. Do you think the Obama administration would ever have the courage to talk about re-examining the tax code? Or tax treatment?
I mean, when you talk about re-examining the tax code, of course, there are all kinds of things that should be fixed. I mean, my other hobby horse is, the extraordinary tax break that goes to property, to all kinds of real estate investment, which actually doesn't really boost home ownership if you look at cross-country numbers, and simply encourages households to take enormous mortgages. In other words, to have leverage. Haven't we discovered leverage is bad? I mean, there's too much of it, and yet we're subsidizing leverage at the household level.
Well, politicians are kind of hooked on it, aren't they?
Yeah, politicians are, but of course, as you know, in the UK, in the 1980s, following a housing crash, the smaller mortgage deduction that existed then was abolished. So governments, democratically elected governments, can sometimes do something about ridiculous tax breaks. And so maybe in an environment where we need tax revenue, that could be re-examined. And I think on hedge funds, sooner or later, I hope that the right thing will happen. They will pay income tax. The trouble comes every time is that when you propose this, then you're basically going to propose a change for all partnerships, not just hedge fund partnerships. And there'll be some other kind of partnership, restaurants or something, which will say, the chef has been toiling away in that hot kitchen. He's created his restaurant, that's a capital gain.
Well, you just look about all the fights over financial regulation and how the laws of unintended consequences came to play and all the lobbying started, and you can certainly imagine that. But I'm curious, you say when you sit down and talk quietly to the hedge fund figures, some of them might say, well, actually, perhaps some change in the tax treatment might be fair or not. But how do you even get to sit down quietly with the hedge fund figures? Because one of the things that makes this whole sector fascinating is the fact they have been very secretive ever since the early days when they were taking clandestine anti-Nazi approaches to actually fuel what they were doing. They aren't an easy world to actually penetrate. How did you get in there and actually get them to talk to you?
Well, I mean, for one thing, it took a long time. It took me maybe 3.5 years to do this book.
What made you decide to write it, actually?
Well, partly this. I mean, in a sense, the challenge of looking at, you look at the global economy, you look at the financial sector, much of it is pretty transparent. Everyone's happy to talk about themselves. The information is there on the internet. The exception seemed to be this secretive, mysterious frontier of hedge funds. And so as an investigative journalist, that was an attraction to try and break into that, make them lift the kimono. And, it wasn't quick. But my idea was, first of all, that if I went to the founding fathers of this industry, they don't have proprietary secrets anymore. And they've stopped trading. So whatever secret source they used to have isn't terribly valuable anymore. So, plus they're retired, so they have time. So you go and see these people first. You really spend a lot of time with them. You really understand what they did. You really make them understand that you understand. And then you say...
And presumably you were doing that before the financial crisis started.
Oh, yeah.
Did you?
Yeah, no, I had this idea for this book in 2006.
Right.
So
we're really at the point of the credit boom in many ways.
Right.
So they would have been feeling pretty good about life as well, I imagine. All their 1.4 billion probably would have been 2.4 billion or something even bigger.
Yes, and also it's human nature. Supposing you've got a hedge fund manager like Michael Steinhardt, who's an explosive character, who managed his hedge fund from the late 60s to the mid-1990s.
He was the one who famously told somebody, when someone said they wanted to kill themselves, he said, "Right, can I watch?" Was that the one?
Yes, exactly. And he, when trading got tense, he would light up 2 cigarettes at once, and he would yell at people all the time. And
I mean, they are extraordinary characters. Which,
So you go and see someone like that, and he hasn't been trading since 1995 actively, but he did have this storied career before, and so he would quite like some recognition. So I mean, he's happy to talk, and in fact, I saw him multiple times. He was very nice to me, even though he used to yell at his own trading staff. I was in his office one day when he discovered that he'd lost money in the Bernie Madoff scandal. And you would have thought he would have been in a bad mood. But in fact, he was perfectly nice to me. And he kind of muttered, furiously about how he lost this money, but carried on talking to me.
Clearly sharp enough to tell what you were up to, and so was trying to play the system well as well, I imagine.
But he really told stories about how, in effect, in the 70s, he broke the rules. And some of the money that he made was by being in this very secretive kind of close-knit club of block traders who used to trade enormous blocks of stock together. And he had basically better information than everybody else, and it wasn't always exactly on the up and up, but it was highly profitable. And he said that to me on tape. So people are quite relaxed if you're talking about what they did a long time ago.
Yes.
And then the key thing as you go forward in the research is that you've now talked to and sort of won the trust of the mentors of the next generation. So if you go and see George Soros and you spend a lot of time with him, you really understand what he did, then he will introduce you to people who used to work for him. And then bit by bit, those people introduce you to the next people, until right at the end of my research, I was getting a call. I was in my office one day, writing chapter 16 or something, and the phone went. And there was Bruce Covenor, one of the more secretive people.
Absolutely. I mean, most people watching this probably have never even heard of his name, but he's a tremendously powerful player, isn't he?
Exactly. I mean,
Tell me what he does a bit.
Well, he set up a fund called Caxton, which is a macro trading fund. In other words, it plays on currencies, interest rates, and sort of plays off a macroeconomic view of where growth is going to go up and down. He started in the late 70s. He was somebody who began with political science. Then he got frustrated with that, tried to be a musician, didn't quite go professional with that, was driving a cab in New York, borrowed some money on a credit card, and bet it on commodities and sort of tripled his money or something.
So the original American dream.
Yeah, and he realized he had a knack for this, and he joined a company called Commodities Corporation in the 1970s, which was based in Princeton. It's one of the very early trend-following, commodity trading, secretive outfits, not in New York, but in this farmhouse outside Princeton. Interestingly, she was set up with the help of Paul Samuelson, the Nobel laureate, who had written in his economics writing about how markets are efficient, but in his personal investing was betting on these traders on the idea that you could beat markets. So anyway,
well, I was going to come on to that in a minute, because that's a very interesting theme of your book about the efficient market hypothesis.
Yeah, so anyway, Bruce Covenor began there. He then set up his own company, Caxton. He grew it and became bigger and bigger and bigger, and was extremely successful, quite influential in conservative political circles, was the chairman of the American Enterprise Institute, a bit of a neoconservative godfather. very secretive to the press, but there he was suddenly telephoning me because
And he talked to you, did he?
Yeah, but partly he did it because by that time I'd already had a 4-hour dinner with somebody who had worked with him for 15 years. So he knew that I knew about what he'd done. So he might as well talk at that point.
So it really was a labour of love then. I mean, did you find, though, that their ability or their willingness to talk to you and their willingness to be frank changed as a result of the crisis? Because, I mean, as a journalist, for example, I spent a number of years looking at, say, the shadowy worlds of the complex credit markets. And certainly before 2007 and after, say, particularly 2008, there was a change because people became much more frightened and much less willing to chat openly.
Yeah, I think there were two things. I mean, first of all, they were frightened, and secondly, they were stressed and busy. I mean, 2008, if you were managing money, was one of the most hectic, intense years ever. And so I was trying to get interviews during that period. It wasn't always easy. I remember being on the train from Washington to New York, having finally snagged my first interview with Paul Tudor Jones, who is another sort of legendary figure in this industry.
And again, someone who doesn't talk that much usually.
No, hardly ever.
Yes.
So I was very excited. I think I was getting the first interview that he'd given in more than a decade or something. And my cell phone went on the train, and he was cancelling the interview, and I was told, you'll understand why tomorrow. And sure enough, the next day there was something in the papers about how his longtime equity trading partner, James Pallotta, they'd split, and basically Pallotta had been forced out, and there were all these changes going on in 2008, which just made talking to a writer not the highest thing on people's priority lists. So I was battling against that.
Out of all the characters you tracked, and you really do, I mean, how many hedge fund managers did you talk to do this book?
I lost count. I mean, I think I did, hundreds of hours of taped interviews, transcripts, and so forth. I mean, I forget how many precisely, but...
Who did you end up admiring most?
Gosh, some of the people who are most fascinating are the ones who don't necessarily explain what they're up to very accurately. I mean, Paul Tudor Jones is a fascinating example where he thinks he makes money because he looks for market analogues. He looks for times, he says, okay, today I'm looking at the market. The S&P 500 index is going up, the volume of trading is going down, the gold price is doing that, the oil price is doing this, the dollar is doing the other. And he says to his research team, find me the past times in markets where these 5 conditions held. And they scurry away and they come back an hour later with charts of all these other. He looks at this stuff and he says, okay, now I can see how it worked out in history when these conditions held. And so I'm going to trade this. Now, I know for a fact, because I've talked to people at his company who sort of analyzed the track record, that this is nonsense. He didn't make money by this. In fact, there's no profit to be had out of these analogues. He doesn't believe this, but I'm sure it's not the case that he makes money like that. And it reminds me of Vic Braden, the famous tennis coach, who said that if you ask tennis pros, why is McEnroe's forehand so fantastic? Is it how he stands? Is it his shoulders? Is it that he flicks his wrist early for that, top spin, or what is it? Not only do the tennis pros not know the answer, McEnroe himself might tell you the wrong answer. And you can film him and break the forehand, film down into slow motion. So you really see how he does it. And it's not what he told you he did. And it's a bit like that with some hedge fund traders. And so I don't know if that's whether, admiring them for that is the right...
Almost like a sort of artistic or creative genius for smelling trades or smelling ability to make money, kind of thing.
And so sort of the intellectual fascination is, they provided an explanation which isn't right. But in the seeds or in the margins of that explanation, there's something else which does make intellectual sense about why they made money. And so with Paul Jones, for example, I ended up thinking that it's a bit like going for a walk. Going for a walk doesn't cause you to have inspiration for what you should write in your next column in the Financial Times. It's not that the walk creates the column, but it puts you in the frame of mind where an idea might come to you. And I think with Paul Jones, when he looks at these analogues, these charts, it puts him in the frame of mind where an idea comes to him.
Right. I mean, if you were a young hedge fund wannabe coming out of college saying, look at all this money, I too would like to have more money than God. I mean, who would you recommend they look at as a good example?
I think somebody like that would have to play to his or her strengths. I mean, you would need to decide, are you a mathematical quantitative type, in which case, your dream is to join Renaissance Technologies, but for this you need, higher order quantitative PhD plus.
You need to be a super geek, basically.
Yeah,
yes.
exactly. Or are you somebody who likes to go and kick the tires at real Main Street companies, in which case you should work for a stock-picking hedge fund that goes out and really understands how a company works and decides, is it going up, is it going down, shall I be long, shall I be short? And there are hedge funds like that that really do make persistent, consistent money. That was one of the things that surprised me, because academics always take mutual fund, stock pickers as one of the proofs that markets are efficient, that prices are random, because there's no persistence in performance amongst mutual fund investors. The funny thing is that hedge funds that do pretty much the same thing do have persistence in performance and do make money. I think you can play to your strengths. There are other kinds of people who just have a gut for risk. I mean, George Soros, his great talent in a way was when he saw a good trade, he would pile on with everything he had. He said, there's no such thing as being too much of a pig. If you see the chance, just go for it.
Yes.
So I think there are different styles for different people.
And who did you end up from your research not admiring? Who did you least like out of all the vast stable of characters you looked at?
I suppose, it's harsh to say this since we got along quite well, but Michael Steinhardt is somebody who in the end I think made money by just basically being inside a club. That he got the first call. The way it worked was that there were 3 big brokerages in the 70s and the 80s that were moving very big blocks of stock. And they needed somebody to sell that block to. A pension fund was selling, they needed a buyer. And so they just knew that Michael Steinhardt was the guy to call because he didn't mind in the space of one phone call saying yes to a sort of multi-million-dollar purchase. The thing was, let's imagine I'm the broker, you're Michael Steinhardt. I call you up and say, will you take this? Now, if you say no, I'm totally stuck because now I've given you the information that there's this big sell coming. So you could say no and then go out and just sell ahead of me. So basically, you can say, I'm not sure, but I'll take it if you give me a $3 discount per share. And you've basically got them by the short and curlies.
Right.
That doesn't strike me as the most intellectually innovative way to make a fortune.
So it was basically about negotiating the power balance between yourself and the bankers.
Being in the right time, place at the right time.
One of the fascinating things that you capture in your book is the way that hedge funds have gone from being maverick weirdo outsiders to coming almost inside the system, and the power balance with banks began to shift. And one of the great scenes in your book is a point where you have Bear Stearns on the point of collapse, and effectively Alan Schwartz calls up Jim Chanos, one of the great short sellers, and asks him to come to his aid by going on television and essentially expressing confidence in the bank, which sort of encapsulates the degree to which, a little group of gadflies had ended up in some ways becoming not just integral to the system, but sometimes having almost an equal power footing.
Yeah, and I think that story actually tells you something about the way that the bubble formed and the way that Wall Street and the kind of media apparatus around it works, actually, because, you've got a lot of people who are just congenitally bullish in finance, as you know. And so if you look at, buy recommendations to sell recommendations that come out of Wall Street houses, there's always been, 99.5 buy recommendations for every sort of semi-sell. And part of the skill that hedge funds have had from early on is to ignore all those buy recommendations, but call up the broker ends, as Julian Robertson used to say to the analysts, I know you regard all of these companies as your own children, but just tell me, who is your least favorite child? So then he knew which one to sell, which one to be against. And it's by being willing to be negative that the short sellers have got a niche, not only in investing, but in terms of information and what they're looking for. Everybody else is looking for what's going to go up. These guys are focused on what could blow up.
Right.
And that makes them an incredibly important source of information. I think journalists...
They're almost like the honest conscience of the system. Well, not the honest, but the conscience of the system, perhaps.
Right. And I think journalists, would do well to talk more. They already are beginning to do it more, but it would be better to talk even more to some of these hedge fund guys who are willing to go short. They are talking
The
their book.
hedge funds haven't always been willing to talk, or you often, when you talk to them, as a journalist myself, I know when I talk to them, I never quite know where they're coming from.
Right. No, that's true. But I think this particular sub-brand of hedge funds, the short sellers, in fact, Jim Chanos is quite open to the press. David Einhorn, who was one of the other short sellers who came to the fore in 2008, is quite open to the press. In fact, people say they might be too open to the press because they're talking their book. They sell something, and then they try and get it down by spreading negative stuff through the media. Now, it seems to me that actually, if somebody has put their own money where their mouth is and sold something and made a bet, as a journalist, I would be more inclined to take their view seriously than if it's some Wall Street analyst who hasn't put money on it either way and is, just sort of spouting an opinion without betting on it. So I don't have a problem with listening to people who are talking their book, but that's not a view shared by all journalists.
Right. Well, that certainly touches on the much wider, more controversial issue of the role of the media in all of this, and the role of the media in covering the hedge fund industry. But in terms of the way that hedge funds operate and the theory that drives them, one of the other fascinating paradoxes in your book is the fact that so much of the hedge fund industry was driven by the theory of efficient markets and free market ideals, and yet in practice what most of the clever hedge fund players are doing is actually exploiting market inefficiencies. I mean, can you square that up at all? Is it a question of people simply not believing their own theory, their own hype?
Well, the people who believed the theory of efficient markets were basically the academics. And they believed it for rather a limited amount of time. I mean, I've read things as a result of the crisis that say, now academia has to finally acknowledge that markets are not efficient. That's all nonsense. I mean, I quote a paper published in 1990 by Andre Schleifer of Harvard with Larry Summers, who now works, of course, in the White House. And they co-authored a paper which said, the quote was something like, if the efficient market hypothesis were a stock, it would have crashed in 1987, along with the Wall Street.
And completely been wiped out in 2008, I think. Yes.
Yeah, that's right. But even in 1990, the point is that academics acknowledged that there were lots of kinks in the efficient market theory. I mean, markets may be efficient to a first approximation, but beyond the first approximation, there's plenty of room to make money.
Yes.
And that's really the story of hedge funds. It's finding those kinks and basically trading against people. I mean, markets would be perfectly efficient if everybody in them was, incredibly focused on just getting the price right. But there are some participants in markets who are not focused on getting the price right. I mean, the extreme example is a central bank, which may be intervening to prop up a currency because of a policy view about where the exchange rate may be. If you trade against those people, the central banks, they're simply, that's sort of free money almost. I mean, when George Soros bet against the Bank of England in 1992, the Bank of England, was buying pounds, not because it thought pounds were worth something, but because John Major, the Prime Minister, was insisting that they would stay inside the exchange rate mechanism. And in fact, Norman Lamont, the finance minister at the time, was trying to persuade John Major that he was crazy. They had to get out of the exchange rate mechanism. They couldn't make it stick. And John Major, for political reasons, sort of refused to listen for another day.
So basically the hedge funds were making a sort of political bet as much as anything.
They're betting against people who are not in the market, who are taking a view without it being a view about the real price of the security. Another example would be, when you have, a bankruptcy and bonds in that company are suddenly all downgraded. There are lots of pension funds which, by the statutes of the pension fund, are not allowed to hold on to the debt. So if the debt loses its value and goes down 30 cents on the dollar, it might be smart to hold it because you think it'll end up at 80 cents. But the pension fund isn't allowed to have that view. It has to sell. So in comes the hedge fund, which is allowed to buy, sell whatever it wants, whenever it wants, just according to what's worth what. And it's trading against this pension fund, which is obliged to sell. I mean, you can't fail to make money like that.
So it's not just about using your brilliant mathematical brain. It's about sort of reading the political climate or reading the insanities or the inconsistencies in a regulatory climate as well.
That's right. And I think, in a way, the subprime story is a bit like that too. There were lots of players in the system which were playing in subprime, buying these securities, either because they, had a regulatory reason that they thought this was too attractive not to do. They thought, because you had to put no capital against it, you could put a sort of off-balance sheet, and, that was very attractive because, mortgage-related securities were treated by the regulators in a way that treated them as safe, or they were AAA rated, and therefore there was, So there were a lot of reasons why banks and other forms of institution over-invested in these things. And hedge funds, because they didn't have those kinds of distortions to their decision-making, didn't make that mistake, for the most part.
What do you think the hedge funds have been doing, say, in relation to sovereign debt? over the last year. Do you think, again, they're trying to take advantage of some of the craziness of the political systems or some of the arrangements? I mean, certainly in the Eurozone right now, there's a lot of finger-pointing in the case of, say, Greece or Spain towards the hedge funds.
Yeah, that's right. I mean, on the one hand, one can be sure that in any big macro disturbance, hedge funds are there trying to make money. Of course they are. That's their job. At the same time, I find it a bit ridiculous when, the Greeks say, oh, our troubles are because hedge funds have been attacking us. Come on. I mean, you said you had a 3% of GDP budget deficit. Then you say, oops, we were lying to you, and it's now 13%. And then it's the hedge fund's fault that you lied, and that you're running a totally unsustainable budget deficit? No, I mean, the primary cause of the Greek crisis is the Greek government. We should be clear about that. But I think, hedge funds, of course, they're trying to make money on the margin. I think we don't know yet quite whether they've been able to. I mean, the macro hedge funds have been reporting results in the last few months. They're not looking actually all that great, suggesting to me that they haven't made out like bandits in this European mess. Partly because it's a harder one to trade. In the 1992 European exchange rate crisis, when Italy and then Britain and then Sweden got whacked about in the currency markets, in each of those cases you could trade the currency of Italy or Britain or Sweden. Now with the euro, you can't, because there's one currency that's all linked together. So you can try to trade CDS against the debt, take a bet on a particular
credit default swaps.
Credit default swaps.
Yes, derivatives.
But as you know, I mean, those credit default swap markets, they can be a little bit illiquid. You have a risk that the government might come in and suddenly declare that they're freezing that market as a
So it's harder to find a strategy than, say, in the days of George Soros, where you simply went out and bought a vast quantity of, or betted vastly against sterling.
Yes, exactly. It's less liquid. As hedge fund people would say, you can't express the view so easily.
Right.
By express, they mean make out like bandits.
Right. Well, it gives a wonderful artistic gloss to what they're actually doing, in a sense. But in terms of looking to the future, I mean, what do you think the future is going to look like, and what should it look like? I mean, are you expecting the hedge fund numbers to swell? Do you think they'll get more assets under management? Or do you think there could be a regulatory backlash against them in the future?
Well, I think there's a couple of things. I mean, I think they will swell. Between 2000 and 2010, the assets probably tripled or something in hedge funds. I think in the next 10 years they could triple again.
So what are they now, just in roughly?
You see different surveys with different numbers, but more or less $2 trillion, or just a bit under $2 trillion.
Which sounds like a lot of money to non-bankers, but of course that's still pretty small compared to the assets of say, the banking industry or the pension fund industry.
Exactly. It's a drop in the ocean compared to those people. So, I think if you took PIMCO, just one, bond asset manager, or BlackRock, put those two together, you'd have at least $2 trillion in assets just in two companies.
Wow.
So there's 9,000 and something hedge funds. Altogether, they're as big as two of these other ones. So they got plenty of room to grow, right? And I think if you look at the best academic research on what value they deliver to their customers, they do deliver real value. I mean, even if you take out all the distortions that exist in hedge fund reporting, and you really clean the data, the point is there is value left over for institutions that invest, even despite all these big fees. So I think the institutions...
even after all this crazy spending on planetariums and turtles and all that kind of stuff.
Yeah, exactly. So I think the institutions are clever enough to see that, so they're going to put more money into hedge funds. And so the hedge funds will get bigger and bigger and bigger. But to my mind, there's a risk, which is that there'll be a few hedge funds which sort of hoover up all this cash, because they are set up to appeal and seduce big institutions. They have wonderful reporting systems. They send you a nice glossy brochure twice a year. They've got...
So they almost look like PIMCO.
Yeah, exactly. I mean, they PIMCOize themselves.
Right. And of course that tends to appeal to governments too, because they can cope with all the regulatory burden that the government puts on them.
Exactly. They've got armies of lawyers. They've got fantastic computer systems that generate, all these reports, all the data that a sort of high-maintenance institutional client would ask for. They just give it to you on a plate. So these kinds of platforms, because to create those platforms is very expensive, so there's a high barrier to entry into that kind of institutional hedge fund. And so I think once you've created that platform, you can just grow and grow and grow. Then you start going public, you issue shares in yourself, and some of them have done that. And then pretty soon, hey presto, you're basically an investment bank.
And then you actually end up with a situation where they could be systemically important.
Exactly. and then they should be regulated. And I think, hedge funds have been wrongly accused of creating a risk to the financial system in the past. But although that accusation has been basically 99% wrong so far, it may be right in the future. So we need to be ready for that.
That's very ironic. I mean, I have to ask you the key question, though, because we're almost finished, but the key question, which is that if you're so fascinated by hedge funds, if you're now such an expert, if you think that they add so much to the broader economy, why aren't you running a hedge fund yourself? Have you never been tempted to join one?
One thing I've learned is that to make money, as I said before, markets are basically efficient to a first approximation. So to beat that, you have to be so focused on what you're doing all the time. I mean, it has to be an obsessive kind of thing. You have to be addicted to watching your investments. And I'm not going to develop that kind of level of I mean, I like writing. I like public policy. I like telling stories. I like writing books. I'd rather spend the next 3 or 4 years, on the next book, as opposed to, obsessing about basis points in the markets.
And what's your next book going to be about?
I don't know that yet. But
so if you wanted regulators or governments or politicians or non-bankers, the kind of people who say, I just don't understand what hedge funds do, but I kind of think they're probably evil, great title, etc. If you wanted them to take away 1 or 2 key messages from this book, what would they be in terms of moving the regulatory debate forward?
I'd say that we have to recognize that there will be risk in financial markets. We have to ask who should manage this risk, and we have to recognize that in the past, when you've had a financial crisis, it's usually because the incentives for financiers have been distorted and encouraged them to take too much risk. Distorted by a government backstop, distorted by a so-called trader's option that individuals within a big bank may want to take more risk because they'll get a big bonus. And the kind of financial vehicle that we have that has fewer of these distortive incentives are hedge funds. The managers have their own money in the fund, so they have an incentive to avoid too much risk. They are not backstopped by the government, so they don't have that safety net. They are monitored very aggressively by their creditors, so that means another safety check. So although they're not perfect, and they do fail sometimes, they fail safely, and it's a better place for risk to be managed than all of the alternatives that I can think of.
It is, of course, a slightly hard sell, though, because of, when ordinary people who are seeing their incomes cut, losing their jobs, look at these extraordinary characters, this fascinating story of how the industry developed, look at all the money involved and look at all the freewheeling, it's very hard for them to not think, well, hang on a sec, why are they off in the Cayman Islands? Why are they doing all this clever mathematical stuff we don't understand? I mean, they make very easy targets.
And the answer is more progressive taxation. Tax the profits, by all means, but don't shut down this form of investment management because it's better and healthier for the financial system and for the economy writ large.
And if they were to tax the profits, I mean, how much money do you think they could raise?
Gosh,
do you build a few schools in the Midwest, or
well, I mean,
fund a bit more healthcare?
I've never been asked that question, but I mean, if we just did back of the envelope, the top 25 hedge fund managers on the list of the biggest earners, made about $25 billion between them. Okay.
What, just when?
Just in 1 year. In 2009, I think.
2009, which was supposed to be a bad year for most of the financial industry. They made $25 billion.
Okay. So if we just hiked their taxes by 20 percentage points, right, you make $5 billion right there. I mean, $5 billion, that's a few schools.
Wow. Well, that's certainly a both inspiring but also quite encouraging lesson to end with. So thank you very much indeed, Sebastian, for providing a truly fascinating look at the industry, which is both very interesting, very juicy, quite racy in parts, but actually raises some very core fundamental policy questions that I, for one, certainly hope that regulators and politicians on both sides of the Atlantic listen to very seriously. So thank you.
Nice to talk to you, Julian.